Alrighty, so today we're going to begin by first addressing a great comment from Julian right over here, and then answering a question from Sachin right down over here. And before we begin, I do want to take the time to thank all of you for the great feedback that I've been receiving underneath the most recent videos. You guys have no idea how motivating and encouraging it is to see that we've developed a community that's actually looking to learn as opposed to only looking for price calls like a lot of other communities out there. So guys, thank you so much. Keep the comments coming and keep the questions coming, because it does help further the discussion like we're going to be having today. So let's go ahead and start with Julian's great comment right over here, because it does allow us to expand far more on what we discussed in the previous video a couple of days ago. And for those of you who did miss the previous video, I really urge you guys to go ahead and watch it. You guys will learn a lot. We discussed a lot, right? These are all the charts that we did discuss, and to just give you guys a preview on how much we broke everything down, here are all my scribbles on those charts, right? So go ahead and check out the video. Posted it a couple of days ago. It will be highly beneficial for all of you guys who are looking to get a better understanding on how to position yourselves for the next bull market and the accumulation strategy that we are going to be employing over here at Mango. Okay, so going back to what we're discussing today, I want to start with Julian's comment right over here. And he references this on-chain metric that we were discussing in the previous video that I said, hey, this is aligning with our thesis. It's aligning with our thesis, but there's a caveat to this that I do want to expand on. Okay, so we'll be doing that today. We'll be expanding on that caveat. So let's start with Julian's comment. He says, thanks, Sean. Brilliant video. Really enjoyed that. Thank you, Julian. He says, as an aside, I think the usefulness of on-chain analysis in general should start improving further now that many more people are moving to self-custody instead of storing their Bitcoin on exchanges. That should, in theory, lead to sharper on-chain signals. Now, I completely agree with this, especially if we start getting more entity-adjusted on-chain data, right? And we are beginning to see this, but not in the way that I would like. And if you guys do remember, in the bull market too, the bull market all the way to 50K, 60K, all the on-chain analysts were getting a lot of attention because things were going their way. But I was really skeptical, right? If you guys were following Mango back then, even though I was really bullish and we were paying attention to that, I always said, guys, price will always be more important than on-chain data. And the reason I say that is because on-chain data, especially as it exists in its current form, makes certain assumptions about market participant behavior. Let me give you guys a quick example using this chart that we referenced in the previous video, right? The Bitcoin realized profit loss ratio. We pointed out that every one of these peaks over here, okay, 2012, 2015, 2019, the COVID dump has lined up with major market bottoms, right? Right over here, you guys can see the black line, guys, is Bitcoin's price, right? This lined up with Bitcoin's bottom zone right over there. This one over here lined up with Bitcoin's bottom at around, I believe this was around $200. Then right over here was the 3K bottom. Right over here was the COVID re-3K bottom. And now right over here, again, we're seeing a major spike in the Bitcoin realized profit loss ratio, and this could potentially line up with our thesis from the previous video where we are saying that we are neither in the inventory flush out zone or in the rising bull market, but we might be in the shakeout zone leading into the rising bull market, right? So we're looking for confirmation on that. But my caveat was that, hey guys, be careful over here, because we need to understand what we're really talking about over here in the realized profit and loss ratio, and how we could misconstrue this, or there could be misleading information in this data over here, because you really need to understand what this is actually calculating, because this could spike down further, and this current spike over here could be misleading or could be misconstrued, right? I'm not saying it is, but once you get a better understanding of how this profit and loss ratio is calculated, you will leave room for that possibility. And that in itself is risk mitigating, right? Because at the back of your mind, you'll be thinking, wait a minute, what about this scenario or that scenario, right? So let's go ahead and walk through a story right over here, guys. Okay, I'm going to walk you guys through a story that will give you guys a better understanding of how to think about on-chain data, especially this ratio right over here. Okay, Let's say Julian buys Bitcoin at $5,000. Okay, so he buys one Bitcoin for $5,000. He waits a couple of weeks and Bitcoin now moves all the way up to $10,000, right? So Bitcoin is sitting at $10,000. At this point, Julian is super happy and he wants to buy his daughter a brand new car. He goes up to Sean and says, "Hey Sean, I'm willing to give you one Bitcoin for that nifty sports car that you have." And Sean says, "Sure, my depreciating asset for your Bitcoin, hand it over," right? So Julian gives Sean the Bitcoin and now Sean has Bitcoin and it's sitting at $10,000. By the way, Julian would never ever do this. He loves his Bitcoin way too much to spend it on a car. But let's go ahead and discuss how the on-chain data is going to be looking at what just happened, okay? And we're going to discuss it right over here, okay? Right down here where we have some space. All right, let's draw a little box right there. Okay, and what we're going to do is we're going to go ahead and draw a representation of Bitcoin wallets, right? So here we have Julian's Bitcoin wallet and over here we have Sean's Bitcoin wallet. Okay, Julian initially bought Bitcoin and received it at $5,000, right? So initially it's sitting in his wallet and Bitcoin's price is sitting at $5,000. Now finally, after a few weeks, Bitcoin goes all the way up to $10,000 and that's when Julian sends it over to Sean's wallet. Okay, this is the point at which the on-chain metric over here is going to say that, hey, Julian has spent his Bitcoin because it's gone from his wallet to a new wallet, to Sean's wallet, right? So what this on-chain metric will do, it's going to take the price at which point the Bitcoin was moved, which is $10,000, and subtract the price the last time it was moved, which was $5,000, right? Because remember, when Julian bought his Bitcoin, it was moved into his wallet and the price was $5,000. And the next time Julian spent his Bitcoin was when he gave it to Sean, right? So the way on-chain is going to look at this is that, hey, Julian has realized a profit of $5,000 because 10,000 minus 5,000 is 5,000, right? So Julian has a realized profit. Let's go ahead and write that down right over here in red. Julian has a realized profit of $5,000, which does make sense, right? This is completely correct because Julian bought for $5,000. When he sent it to Sean, he's essentially realizing a profit of $5,000 because Sean gave him a $10,000 car. Okay, cool. All well and good. So at this point, the on-chain data has actually recorded this appropriately because Julian did realize a profit of $5,000. But let's go back to our story, okay? And let's see how this unfolds. And for now, let's go ahead and clear all of this because we don't need these drawings right over here. I'm just going to make some more space first. All right, cool. Now let's recap our story. Remember, Julian bought Bitcoin at $5,000. He spent it at $10,000. He gave it to Sean. Now that Bitcoin is sitting in Sean's wallet, right? So the on-chain metric has now realized a $5,000 profit under Julian. Okay, cool, all well and good. Now Bitcoin drops down to $8,000. Okay, $8,000. And Sean says, whoa, a 20% discount on Bitcoin? I want to buy some more Bitcoin. But the problem is Sean does not have any fiat readily available on the exchange to take advantage of that $8,000 price, right? He has to first go to his bank, send over the money. By the time it reaches the exchange, Bitcoin may have bounced all the way back up to $10,000, even higher. So what does Sean do? He decides to send over his Bitcoin to an exchange that will allow him to use his Bitcoin as collateral to buy more Bitcoin, right? So for example, what I would do is I'd send my $8,000 worth of Bitcoin to buy $2,000 worth of more Bitcoin, okay? In the meantime, I'm waiting for my funds from my bank account to arrive. And I can wait very patiently, very stress-free, very mango on this position while my funds arrive. I can even tolerate several delays. Why? Because I have only a 0.25x leverage. I've done this in a very safe way. I've not sold Bitcoin. I've in fact bought more Bitcoin, right? Now I have a total of $10,000 worth of exposure. But how is the on-chain metric going to read this? Because remember, according to the on-chain metric, Sean has now sent his Bitcoin from his wallet to a new wallet, Kraken's wallet, right? At a price of $8,000. So according to the on-chain metric, Sean has realized a loss of $2,000. Because remember, all the on-chain metric cares about is whether the coin has moved or not. It doesn't know what I've actually done with the coin. I could have sold it on the exchange, or I could have used it to buy more Bitcoin while I wait for my funds to arrive from my bank account, right? It has no idea why I have actually moved the funds. It just assumes that, hey, if you've moved the funds, you have either realized a loss or you have realized a profit, right? So, for example, Julian moved his funds to me, right? And he did realize a profit. But what if he just simply moved it from one of his accounts to another account, right? What if he moved it to another wallet of his? What if he moved it from a cold wallet to a hot wallet? Well, that would have also counted as a profit, but he wasn't really realizing a profit, correct? Now, similarly, guys, this spike over here, I want you guys to draw your attention back to this spike, okay? This has happened at a time where we had a massive counterparty risk episode, right? An exchange went down, one of the top exchanges in the space. Everyone is spooked out, and a lot of people sent funds from whatever exchange they were in out into their hardware wallets, right? So in this case, even though they have not realized a loss, right, the on-chain metric would record them as realizing a loss because they have spent their Bitcoin according to the on-chain metric, right? Because as long as they've moved it, even if it's from their exchange wallet to their personal hardware wallet, it's going to be recorded as a realized loss. In fact, there are likely a lot of people like myself who first send funds into their hot wallet, right, guys? A hot wallet, and then sent it into their hardware wallet. So how's the on-chain metric going to record this? Well, there's going to be a realized loss over here, right? Because this movement, and then price likely went down even further in that period because price was moving down so fast, and then another realized loss between the time where we sent it from our hot wallet to our hardware wallet. Now, guys, all of this is not to say that on-chain data is useless. That's not what I'm saying over here. What I'm trying to say is understand what it's really telling you. Try to think of scenarios and edge cases that could lead you to misconstrue the data. For example, right over here on this most recent spike of the realized profit loss ratio, I would personally take this with a grain of salt and wait for a rise of the realized profit loss ratio before saying, hey, you know what? Everyone has already realized their losses. Because this spike over here, guys, could just mean that people have moved their funds from exchanges into their personal wallets, right? And the spike is going to record that as a realized loss when it's not really, right? We don't know that for sure yet, right? Let's wait for some time. Similarly, in a bull market, right, when you see a lot of on-chain data analysts say, hey, people are moving their funds out of the exchange. Hey, people are moving their funds out of the exchange. Well, that could simply be because now we have all these financial products available, guys, futures, options, CoinM. We have all these products available that allow us to defer counterparty risk, right? I've been talking about this for a very long time, for years now. I've said, do not keep your funds on the exchange because you can use leverage in a safe way, kind of like how I showed you guys over here, to take on your position sizes, and then you can even settle it with real fiat, right? So if you want to buy Bitcoin during a rising bull market, you can use a small portion of your Bitcoin to take leverage as the market is rising, and then send fiat in slowly and surely to settle your positions and then send it back to your hardware wallet, right? We talk about all of this in the C program, how to risk manage, how to defer counterparty risk, etc., while also taking advantage of the rising markets and the bear markets as well. So again, guys, all I'm trying to say is on-chain data, very useful, yes, but always keep your eyes open for how it also may be misleading most other market participants.